Welcome. Today, we are going to solve one of those puzzles in finance that just seems to trip everyone up. When interest rates go up, which sounds like good news, right? Why does the price of your bond go down? It feels completely backward, but don't worry, we're about to make it all click.
So let's just stare this question right in the face. I know, your brain is telling you up should equal up. But stick with me for just a few minutes, and I promise you're going to get this on a gut level. It all boils down to one simple idea: competition.
All right, so before we can get to the rule, we have to be super clear on what we're talking about. What even is a bond? Well, think of it as a simple, legally binding promise for future cash. Let's break down exactly what that promise looks like.
Okay, this is like the bond's DNA. These are the promises that are set in stone and can't be changed once you buy it. The par value is the $1,000 you get back when it's all over. The maturity is just how long it lasts, in this case, 2 years. And the coupon rate, that's the interest it pays you along the way. 10% a year, paid out in two $50 chunks. And here's that promise in action. This is the exact cash flow you're getting. You get $50 every 6 months, like clockwork. Then, at the very end, month 24, you get that last $50 coupon plus your original $1,000 back. The most important thing to remember here is that this schedule is locked in. It will not change no matter what.
So, you've bought your bond, you're happy with your locked-in payments, but here's the catch. The rest of the world doesn't just stop. The second after you buy your bond, the interest rates out there in the market start to move. And this is where the entire puzzle starts to unfold.
Okay, let's think this through. The market suddenly gets hotter, and to attract new investors, companies start issuing brand new bonds that pay a whopping 15%. Now think about your bond, the one that's stuck paying only 10%. If you wanted to sell it, would anybody pay you the full $1,000 for it? Of course not. Why would they buy your old, lower-paying bond when they could just get a shiny new one that pays 15%? And this is the heart of it all. Your bond's value is all about how attractive it is compared to the new stuff. When new bonds are paying 15%, your 10% bond looks pretty lame. To get someone to buy it, you have to sell it at a lower price. The price has to fall. But what if rates go the other way? Imagine new bonds are only paying 5%. All of a sudden, your 10% bond looks like a superstar. Everyone wants it, and they'll bid the price up past the $1,000 just to get that awesome income stream.
So there's a name for this. In that first scenario, where rates went up to 15% and your bond looked less appealing, you'd have to sell it for less than its $1,000 face value. That's called trading at a discount. Makes sense, right? You're giving someone a discount to make up for the lower interest payments.
And on the flip side, when market rates dropped to 5%, your bond became a hot ticket item. People would actually pay more than the $1,000 par value for it. That's called trading at a premium. You get a premium because your bond's payments are so much better than what's available now. It's just simple supply and demand.
Okay, so the whole competitive thing, that intuition, it makes sense. But for anyone who's still a little skeptical, let's actually prove it with some really straightforward math. And to make it as simple as possible, we're going to use a special kind of bond. We're going to use what's called a zero-coupon bond. It's exactly what it sounds like. No little payments along the way. It's just one single promise. You pay some price today, and in exactly 2 years, you get $1,000. That's it. This strips away all the other noise and lets us see the core relationship crystal clear. So how do you figure out the price of something that only pays out in the future? Well, you have to work backward. We know we get $1,000 in 2 years, but we have to discount that back to what it's worth today. The interest rate is basically the fee for time traveling that money back to the present. And since it's 2 years in the future, we apply that discount factor twice.
This quote absolutely nails the mindset. The higher the return an investor demands from their money, the less they're going to be willing to pay up front for that guaranteed $1,000 in the future. Let's see how the numbers play out.
All right, let's start with our baseline. Let's say a fair return for this kind of investment is 10% a year. If that's what an investor expects to earn, what would they pay for this bond today?
You run the math and it comes out to $826. Paying that today to get $1,000 in 2 years is the exact same thing as earning a 10% return each year. So that's our starting price.
Okay, price is set at $826, but now the market changes. Things get riskier, or maybe there are better opportunities elsewhere. Investors now demand a 15% return. So the prevailing interest rate goes up. What happens to our bond's price?
The price has to fall. It drops to $756. Think about it. That $1,000 payout is fixed.
So the only way for a new buyer to get a higher 15% return on their money is to pay less for it today. The math doesn't lie. Higher interest rate means a lower price. Exactly what we thought.
All right, let's finish this. What if the opposite happens? The market cools off, and investors are now happy with just a 5% return, so interest rates go down. What happens to the price now?
It jumps up to $907. Because investors expect a lower return, they're willing to pay more money up front to get that same guaranteed $1,000 in the future. It's less of a time travel fee, so the present value is higher.
So, we've gone through the intuition. We've walked through the math. Let's just boil this all down to the one fundamental rule you absolutely need to remember from all of this.
This is it. This is the whole game right here. It's a seesaw. When market interest rates go up, the prices of existing bonds go down. When interest rates go down, bond prices go up. It is the fundamental inverse relationship that drives the entire bond market, period.
And that leaves us with one last really big idea. Now that you understand this mechanical relationship, you can see how powerful it is. This is the exact lever central banks pull. By raising or lowering interest rates, they make existing bonds and loans more or less attractive, which influences spending and investment across the entire economy. It's one of the most important tools they have, and now you understand how it works at its very core. I really hope this helps solve the puzzle for you.